In 2025, the U.S. Treasury is set to roll out a range of new policies that will significantly influence how investors operate in the markets. These changes aim to address economic challenges, improve fiscal health, and align financial practices with emerging global trends. Here are the top 10 ways these new policies will affect investors in the U.S. 1. Increased taxation on high-income investors. One of the most notable changes under the U.S. Treasury's new policies is an increase in taxes on high-income investors. The government is focusing on wealth distribution and ensuring that the wealthiest individuals contribute more to public finances. This could lead to higher capital gains taxes and adjustments to tax brackets for investors with substantial earnings from investments. 2. Changes to tax-deferred investment vehicles. New policies will also impact tax-deferred investment vehicles like IRAs and 401(k)s. Investors may see lower contribution limits or changes in the tax treatment of withdrawals from these accounts. These adjustments could encourage investors to explore alternative retirement savings options or accelerate their contribution strategies. 3. Introduction of green investment incentives. As part of its commitment to sustainability, the U.S. Treasury is likely to offer tax incentives for green and sustainable investments. Clean energy and sustainable technology companies will be key beneficiaries, as investors may enjoy tax credits and deductions for contributing to the green economy. This could spark a surge in demand for green bonds and sustainable ETFs. 4. Expanded financial transparency and disclosure. The Treasury is pushing for greater financial transparency from corporations, which will directly impact how investors analyze and choose stocks. Publicly traded companies will be required to disclose more detailed financial reports, especially regarding environmental, social, and governance (ESG) factors. This will help investors make more informed decisions and encourage companies to adhere to ethical standards. 5. Impact on Treasury bond yields and demand. Changes to U.S. Treasury policies, especially around debt management and government spending, will affect Treasury bond yields. Investors who rely on these bonds as a safe haven investment may see shifts in yields, particularly as the Treasury adjusts its debt issuance strategies in response to economic growth or inflation. 6. Influence on the stock market and corporate tax rates. The U.S. Treasury is planning revisions to corporate tax rates, which could impact stock market behavior. A higher corporate tax rate could reduce corporate profits and lead to lower stock prices, especially for large-cap companies. Conversely, lower tax rates might stimulate corporate investment and lead to higher stock valuations, particularly in sectors like technology and manufacturing. 7. Impact on the housing market. New policies may also have significant ramifications for real estate investments. If the Treasury introduces measures to regulate mortgage lending or adjust housing tax credits, this could either stimulate or cool down the housing market. Investors in real estate investment trusts, REITs, and residential properties will need to adapt their strategies accordingly. 8. Changes to international investment regulations. The U.S. Treasury is expected to implement new policies aimed at international investment and capital flow regulations. This may include tighter scrutiny on foreign investments in U.S. companies or the imposition of tariffs on foreign goods and services. Investors holding positions in international markets or foreign stocks may need to reassess risk levels and the potential impact on global investment portfolios. 9. Shift in monetary policy and interest rates. In line with the Treasury's fiscal adjustments, there will likely be a shift in monetary policy and a possible rise in interest rates. This will impact bond markets, housing loans, and consumer spending, all of which directly affect investors' returns. Those invested in interest-sensitive assets, such as bonds or real estate, may need to adjust their portfolios to minimize risk. 10. Expansion of digital asset regulations. As part of a broader effort to regulate digital assets, such as cryptocurrencies, the Treasury is likely to introduce new rules for cryptocurrency taxation and digital wallet regulations. These policies will provide greater clarity for investors in the digital asset space and create a more secure framework for crypto investments. However, these regulations may also pose challenges to some cryptocurrency platforms and cause volatility in the market. With the U.S. Treasury's policies evolving in 2025, Investors need to stay proactive and informed to navigate these shifts effectively. By understanding these upcoming changes, investors can position themselves strategically to capitalize on new opportunities, while mitigating risks posed by regulatory and economic adjustments.